Hello.
Hey, Ronnie.
Hey, Neil. How's it going?
Good. How are you?
Doing good. Just wanted to say your webinar on the build to rent, phenomenal. So I hope you talk about that today.
Sounds good. Yeah, maybe a little bit. I think it's astonishing what's happening out there.
Absolutely.
I feel very blessed. I'm not sure what I've done to be this blessed, but I definitely feel blessed.
Yeah, I think it's a good strategy. So looking forward to seeing like the trends and your insights. So you got
Yeah.
we got John on the call. How's it going, John?
Hey guys, how are you?
John,
Good to see you.
how are you, my man? Good to see you again.
Yes, sir. Doing good.
I'm glad. John, where in Texas are you?
I'm in Frisco.
Frisco. Okay. Yeah, my sister lives in Plano, so pretty close to you.
Oh, all right.
We'll get together the next time I come see her.
Yeah, please do.
Yeah. Amazing market. Did you know that according to CBRE, there's a CBRE kind of annual cap rate survey that came out. And for the last 15 years, the lowest cap market in the US has always been either New York or San Francisco.
Right.
And in 2021, it's Dallas.
Wow. Well, we're definitely feeling it here for sure. The prices.
Yep. Dallas #1, Austin #2, San Antonio and San Francisco joined #3, New York #11.
Yeah. Amazing.
How the world changes. And we were saying it all along, man, and it just changed very quickly.
Yeah.
So it's good for us.
What did I
Yeah,
miss, guys? What are we talking about? You guys talking
What's
about
going on,
the
Neil?
world or what?
We're just talking about the changes to cap rates in the last 12 months have been so astonishingly fast that it's impossible to keep up.
It is. It absolutely is. And good to see you, Neil. It's been a while, my friend. And we
Yeah,
appreciate
great to see you
hopping
too,
on.
Ben.
Yeah.
Hey, here's Ferris too. Hey, Ferris.
What's going on? How you been?
Oh my God, busy man. I'm launching a $50 million fund next week on next Thursday. And just preparing. So it's a built to rent Central Texas fund. No Dallas, unfortunately, John, but San Antonio, Austin, Fredericksburg, which is my favorite market in Texas. Wine country, rich people.
Not a bad market, my friend.
Emphasize the rich people part.
Trust me, there's probably plenty of people. That's where they want to retire to, too. You know.
Yeah, the hill country is really nice. It's very, very nice there. So I went there and we were checking out properties there. Eventually, we put one in contract. But as we were doing it, we decided to go check out this gated community. It's 5 miles from Fredericksburg, right? So it's up in the hills. And they were showing us all these homes. They were thinking we want to buy one for our, for our company. Like this one's 8 million, that one's 12 million, and this belongs to President George Bush. And it's like they're like, what the heck? Is this in California or in Texas? Like the place was just completely crazy. So it was a fun tour.
Yeah, no, and it's close enough to the bigger cities too that you could still live out there. That could be your weekend home or whatever, right?
Yeah, it's like Austin, I think it's 70 miles, and San Antonio, it's about 60 miles. So it's not too far at all, especially if you live in Northeast San Antonio. San Antonio is pretty rough, but the Northeast part is, the expensive part. From there, it's maybe 45, 50 minutes to get to Fredericksburg. So,
Yep.
So yeah, I like Fredericksburg. You guys will enjoy I'm not going to mention it today in my presentation, but I'm building 55 plus single family home built to rent in Fredericksburg. So large project.
Love to come out and see it. Next time you're in Texas, man, you got to hit us up. It's been way too long, my friend. So
absolutely.
Well, let's. I guess we're actually a couple minutes already behind. So Ferris, we want to kick it off. Do you want to wait for a couple more people to straggle in, or?
Yeah, let's give it another minute or two and then we get going.
Sounds good. Look at Ferris, like in his t-shirt, all relaxed.
I
He's
know.
like,
He's
I'm
typically on the
chill.
beach.
I got my
I'm-
glasses on too. So my beach background is screwed up. So I'm in my home office. Had to bail the office a little earlier today. So
I'm still. At
I
the
like,
office
yeah,
working.
I tend to do that. My office is downstairs, but I like this room. This is actually my loft. You can see that massive TV back there, and with the LED lights around it. So I actually like working up here. It's more space.
yeah, see, I like being at the office much better, but this will suffice for now.
I'm too ADD to work from the house. I've come to that conclusion. That I really found that out during COVID. There's a couple weeks where I did try to do it, and it's just not for me, because you always find stuff to get into, right? Oh, I need to do this or that, or you got this distraction or that distraction. And so the office actually turned out to be pretty good for us, because it kind of allowed us to kind of come in and focus on things.
Makes sense. Makes sense. Different
some
strokes.
folks are way better at focusing than I am. It was always a challenge for me, though.
That works for our company.
Go. All right. Let's go ahead and kick it off.
Yeah, let's go ahead and kick it off. So I guess I'll go ahead and kick it off. So welcome everybody to the Texas Multifamily Masters virtual meetup. For those of you that don't know, this is an event that we basically kicked off after COVID started. So COVID obviously forced the world to go virtual, and so did we. So, for those that don't know, Ben and I run the Houston chapter, and our partners up in Dallas run the Dallas Multifamily Masters chapter. And we figured, hey, instead of everyone doing their own meetup, we figured we'd do one big virtual meetup. And so that is what you all are attending. For those that don't know, Multifamily Masters is a national meetup group, right? We're basically, it's a grassroots efforts. People can, all fly the same banner, but really run their own localized meetups and kind of do what they want. So, Ben and I run the Houston chapter, and our partners run the Dallas one. And for those that are coming out, we are doing Multifamily Con this weekend. So look forward to hopefully seeing a lot of you there. But with that said, I'll introduce myself and let Ben, and then let our Dallas friends go. And then I will introduce Neal a little bit later. So I'm Ferris. I have a company called Disruptive Equity. We have properties throughout Texas and Georgia, and we also are vertically integrated and have our own management company. And we like multifamily, and so we do multifamily A to Z, as well as other asset classes and partnerships. And we're also launching a pref equity fund here as well. So lots going on in our world, and I will hand it off to my less handsome partner, Ben.
Well, some people would say smarter, though. So, at the end of the day, no, Ben Suttles, the other half of Disrupt Equity. Ferris did a fairly good job of introducing us, but ultimately, we love buying multifamily. We love commercial. We love, everything that kind of real estate and is involved, right? All the way up to pref equity fund and, the management side. But, we enjoy, I think, first and foremost, the relationship side of the business. And this meetup, or a variation of this one, the one that we have in person, was where me and Ferris, ultimately met. So this stuff works, folks. So, don't just hang out. Neal's going to bring a bunch of fire and a bunch of awesome content, but stay around for the networking as well, because that's just as valuable, right? You might find your next investor, your next partner on the deal. But, I'll go ahead and hand it off to Mr. John Montero to introduce himself.
Yep. Thanks, guys. John Montero. I'm based up here in Frisco, Texas, in the DFW area. Econ major and MBA. Much like Neal, I love tracking trends and data and cycles. And in May of 2009, I put a bet on Texas. I picked up the family from Hawaii and moved them to Frisco, Texas, 12 years ago. Just thought that Texas was going to come out of the last recession well, and it's been a great move for myself and my kids and my wife. Full-time real estate investor, developer, operator, just under 6,000 doors, all in Texas. We focus primarily on DFW, Houston, and San Antonio. Also develop and build new construction multifamily as well. And part of the Texas Multifamily Investor Network, big Facebook group on Facebook. So if you haven't joined, please join. A lot of good conversations and information shared on that group page. So good to have Neal on board, and look forward to his presentation this evening. I'll hand it over to Ronnie.
Thanks, Sean. I'm Ronnie Phillips with the Kingland Group. We're a real estate private equity firm based in Dallas, Texas. We focus on Class A and B multifamily across the Sun Belt region. We've bought and sold 572 units, and really excited to hear what Neal has to say today. And I'll hand it over to Anton.
Hi everyone, Anton Madley, co-founder CEO of Peak Financing. We arrange financing for commercial real estate, not just multifamily, but multifamily is our bread and butter. I have been in that space now, operating on the investment and financing side for almost 30 years. So I've seen a lot of cycles, and this cycle here is as crazy as ever. So I'm looking forward to hear what Neal is telling us from what he has found over the last couple of weeks. It's always very entertaining to listen to Neal, so I'm looking forward to that.
So Neal's just entertaining, not informative. So with that said,
That's the next presentation.
That's the next one. All right. Well, so obviously we're not all here to hear us talk, right? We're here to hear Neal. Neal's a good friend, fellow techie. Met Neal, what, 3 years ago, Neal? And
About 3 years, yeah.
Yeah, it's been 3 years. So I've known him for a while, and it's been fun to see both sides, I guess, continue to grow and get into different things. And so figured it'd be great to have Neal come on, and really does a great presentation, deep diving into the data, right? He likes to self-proclaimed mad scientist of real estate. So with that said, Neal, you want to go ahead and take it away and rock and roll?
Awesome.
Thank you for coming on out.
Here we go. Thank you, guys. It's awesome to know all of you. I mean, I have met everyone that just was talking. I've met all of you. John, I've met you lots of times. Ferris and Ben, of course. We've been friends for years. And this is a really great thing that you guys do, this multifamily meetup that you guys put together. I've been here before. I've gotten connections. I've gotten partners. I've gotten investors. This stuff really, really works. You just have to keep coming and keep trying. So for everyone's sake, I hope that you're going to keep coming, and I'll get started. All right. My name is Neal Bawa. I am your storyteller for this evening, and this is a story that I've wanted to tell for many years. We've got a large database of investors, and I do 7, maybe 8 different presentations for them, and they cover different sorts of things. And this one, for the longest time, what I wanted to do is I wanted to zoom up in Virgin Galactic's new rocket to this 50-mile level, and then look down on the real estate world from space and figure out some truly disruptive trends that are driving real estate forward for the next 20 years. These are the game changers, the Amazon and Google level events that are happening right now. And we took 50 different trends. We looked at everything from 3D printing to what's happening in real estate materials, nanotechnology in real estate, and then we kind of pushed that down to, okay, what's happening now? And so today I'm going to present 5 trends, not 10. 10 would be too many. I think it doesn't make for a good conversation. I'm going to present the 5 that our community voted as their favorite amongst the disruptive trends that we've presented. So these are very profitable. They're earth-shaking. It's a terrific story. I think most of you know me well, but in case someone's new, I'm a very quirky and opinionated data scientist. Are about 500 million in projects. We've done 22 projects and are launching, and this is true, we're launching 9 of them this quarter. So this is my only speaking engagement this quarter. That's how much I love Ben and Ferris and everyone else in this group, because I canceled all of the others because there's 9 projects coming. 2/3 of our projects are new development. I love being a developer. 1/3 are just like Ben's and just like Ferris's and all of you other guys. I love value add, but the word value add is becoming sort of weird. So I like doing what is known as super value add. So I buy properties that are zoned for more units than have been built. So for example, my Dalton, Georgia property was 151 units and it was zoned for 237. I first built 29 units using short-term lending. I made my investors 44%. I exited, then I rebought the property, and now I'm building another 48 units. That's called super value add. It's a very interesting value add strategy. Anyone can do it. Anyone that's in here can do it, because building 30 or 40 units in a property is much harder than building a property from scratch, because it's already zoned and the land is free. No one can stop you. It's already zoned to multifamily. You're building inside your own. So when I do value add these days, super value add is what I tend to focus on the most. Those are some of our other value adds, sold some of these. As you know, these days we can all brag about these crazy outsized returns. We have one exiting at 40% and one exiting at 50+%. What I like to say is, I think these were all 20% return things, and then the market just went completely insane. So I'm focused on 20%. What the rest that happens is really the market. Some of our investors like us. Sarah Lou is actually invested now in 6 projects. She had invested in 4 when she wrote this project, wrote this testimonials, and she's now invested. She's now exited 3 out of those 6 projects. She loves our use of technology. She loves the fact that we're we report a lot to our investors. So every single month on the 24th of the month, 22 updates go out. Before I get started, here's the disclaimer so that my lawyer's happy. This is educational. We're going to make lots of investment recommendations today, but you're free to accept or reject them. Investments are all risky. Be aware of your risk tolerance level, and also understand that recommendations are not guarantees of performance. Consult a professional. Make sure that you understand you can still lose money. All right, my lawyer's happy. Let's get this show on the road, and some housekeeping. I think you guys are recording this. Yes, this one's being recorded.
Yep.
And I will be sending a copy of this PowerPoint deck out to the organizing group, and they'll send it out to you. You don't need to make notes on what's on the slides. You do need to have a pencil in your hand and a pad of paper, because at some point I'm going to quick fire a whole bunch of cities that you've never heard of that some of these trends are affecting. All right, let's get this show on the road. So I told you I'd tell you about 5 trends, and these trends are all tied back today in some way or the other to COVID. Now, COVID is not one of these trends, but it's accelerated all 5. And remember what I'm about to say. Hitler brainwashed 20 million Germans. COVID brainwashed 7 billion people. It has affected us all. It changed us all in very subtle ways. We have new fears, we have new needs, we have new comforts. And there lies the opportunity of the next decade, because people don't just snap back after trauma. If that happened, PTSD wouldn't last for more than a few weeks. It takes decades. That's not the way the human mind works. Once you understand that what just happened was the only event of its kind in history, 7 billion minds were changed, then you can look into the future and see trends that you simply could not see before. And as you can see, COVID changed things. On the screen, you see a bunch of things that were hugely affected by COVID in good ways and bad ways. The ones in the first row, they're all well known. As you go down the row, there are actually some trends there that may not be as obvious, that I think are more powerful for investment. So just scan through those so I can get you ready for the trends. Take a look. All right. With those in mind, it's time for our first disruptive trend, and that trend is hybrid work. I've done so much research on this, and I can say with absolute certainty that the world will never go back to where we were before the pandemic. HR department after HR department is releasing surveys that for white collar workers, the meaning of work has changed completely. Google, Apple, Facebook, Microsoft, many other companies, they're facing mini revolutions by their employees. Apple's move to offer just 2 days of remote work with 3 days of the office didn't go over well. Reportedly, there are thousands of employees that want more flexibility, or they're going to vote with their feet. So let's dive deeper into this hybrid work phenomenon and what it means for you as a real estate investor. Now, COVID was and is the greatest single home working experiment in history. It's not that people were trained to work at home, guys. There's something much more important. We simultaneously trained every CEO on the planet to run their companies remotely, something that wouldn't have happened in 50 years. They all discovered to their shock, they get more work out of employees than they did the year before. And as a result, 2021 will forever be known as the first year of the hybrid office phenomenon. Just as we become used to on-demand streaming and shared cars and shared vacation homes, the office will increasingly become a place where employees go when it suits them or when it fulfills some kind of specific need. Take a look at the screen. 95% of employees want hybrid work, 95%. 75% are willing to trade perks for flexibility. 64% are willing to pay more for access to a workspace in their own home. And that's why Ben and Ferris are right now furiously looking at their upgrade charts and saying, where can I put in an office nook, right? Office nooks, hottest thing ever. Right? Just even if it's like 2 feet by 3 feet, it's an office nook you can now rent for $50 more. That really matters today, right? Bottom line is that these things are huge. Employers are bowing one after the other to demand from workers. And if they're not, well, here's a statistic. Some of you know this. The number of employees resigning their jobs, if not offered flexibility, is the highest in history. As they say, once you get addicted to a better life, people will not go backwards easily. All right, fine. That's fine. What does this mean for me, Neal? I'm a real estate investor. So I have 6 takeaways for you up on the screen. Number 1, we're continuing to see people move to distant suburbs, underline distant. They're even moving to rural or remote communities. We are now living in the age of the true tertiary market. I'm investing in Idaho Falls, nearest city, 150 miles away. I'm investing in St. George, nearest city, 125 miles away. True tertiary markets are incredibly hot because for the first time ever, institutional investors are buying assets in tertiary markets because they're still, I mean, everything else is 4 cap, tertiary markets are still 5 cap. Tertiaries are going to be one of the biggest things. Next, we will see demand for more bedrooms. We will see a demand for larger homes, and larger apartments are going to become the norm. If a metro's hottest demand was for 3-bedroom homes, it's now 4. If the strongest apartment market was for 1 bedrooms, it's now 2. Tied to that is a greater need for co-working spaces, but not in downtown San Francisco or New York, but in the suburbs. I don't invest, I'm not a syndicator of co-working spaces, but right now, if I see a co-working syndication in the suburbs, I go put my money in it. So I think there's a great investment opportunity there for you. It's not necessarily with us, but it's there. Finally, we see bidding wars continuing and accelerating in suburbs and remote communities. And when we say suburbs, we used to say, here's a city, 30-mile radius, that's it. Please draw those radiuses. I'm in Phoenix. It's the hottest market in the United States. It's got the lowest cap rates as per CBRE 2 weeks ago. Cap rates in Phoenix are 3 to 3.75. But here's the cool thing, right? And Texas is not far behind. You just go up maybe a quarter point, and Dallas, then San Antonio and Austin are right there. They're 0.25 behind Phoenix. But that's not my point. My point is this: in Phoenix, there used to be that the center of Phoenix, downtown, is where the cap rates are lowest. And that was the case for the last 30 years. But here's the most important thing that came out in the CBRE survey. For the first time in history, suburban cap rates were lower than cap rates in CBD or central business districts. They're not much lower, but what's happening is CBD cap rates are going up, suburban cap rates are going down. Also, the other thing that they mentioned is the 30-mile radius doesn't work anymore. In Phoenix, prices are rising the hottest where? Not 10 miles from Phoenix, not 30 miles where I invest. On one side of Phoenix is the city of Avondale. I'm building a massive 320 unit there. On the other side is Mesa. I've already almost completed building a 240 unit there. And I was like, I'm 30 miles out. I'm at the edge of the radius. I'm good. And I am, because those projects are insanely profitable. But here's what I'm seeing. Here's what my data tells me. The cities that are hottest are 50 miles from Phoenix. And those 2 cities that are hottest are Buckeye, Arizona. Write that down. Buckeye, Buckeye, Arizona. And Maricopa, Arizona. The radius is expanding. And as the radius expands, the ones on the edge are actually rising the fastest. It's the age of the distant suburb. Our next trend is the transformation of retail. The quote on this screen is so awesome. I'm just going to read it. The pandemic has been dubbed the great accelerator. For retail, that means e-commerce taking a greater share of sales, store fleets being further rationalized, and retailer and retail REIT bankruptcies being pulled forward. So there's a slew of retail bankruptcies that are starting just about now. Now, I want to start out by pointing to the chart on the right. See on the right side of the screen? This shows the percentage of retail sales that come from e-commerce. As you can see, over the last 20 years, it's been a nice and smooth increase, 0, 5%, 10%. And then COVID happened. And we see this stunning once in a lifetime growth. E-commerce sales currently have straight line growth, which is why Jeff Bezos is one of the richest men in the world, even after he gave $40 billion in a divorce to his wife, right? And what about brick and mortar? Well, on the left, bullet 1 and 2 talk about the massive hit that malls are taking. Vacancies at record high. 25 malls have been purchased by Amazon to create distribution centers. We're expecting 30% of mall-based department stores to close by mid next year, and Amazon's taking advantage. But bullet 4 points out something important. Brick and mortar is not going away. It's going through a painful evolution. They are getting on our turf. Do you understand what I'm saying? They're getting on our turf. Retail is morphing into live, work, play, outdoor malls. These are a newer type of outdoor malls. Guess what they are? They're a combination of apartments, retail, offices, and hotels. My favorite example is Simon Properties Domain project in North Austin. The offices at the Domain provide customers for restaurants and retail stores during the day, and the apartments provide customers for them during the evening. Isn't that a much better model? That's way more resilient, multiple streams of income, right? Smart concept. And something bizarre has happened. I was predicting that Simon and Westfield would go out of business. These guys turned out to be really smart. I turned out to be the idiot, because guess what they became? They realized what's happening to them. They became apartment developers, right? So what they're doing is they're taking all of their malls and getting approvals from cities to build another 500 apartments. So retail is morphing. All right, Neal, how do I make money from this trend, right? Write this down. Amazon stock is expensive, right? Very expensive, super expensive. But have you considered investing into industrial real estate projects? Look at that straight line on the screen. If retail demand goes down, wouldn't you see a corresponding increase in industrial and fulfillment centers? Because think about it. I mean, that is retail for e-commerce. You have to store all those trillions of boxes. This is why we built an industrial project. We built in Utah. And before we built it, all of it got sold out to 1031 buyers that are 1031ing into industrial from stuff like multifamily. Amazing stuff. We didn't put any tenants in. We already sold it. Good for our investors. We might do few industrial projects more in the future, but don't hold your breath. Go look for industrial assets. We think it's a phenomenal asset class, absolutely phenomenal. Now, there are other ways of investing in this particular trend that don't involve syndication. You can invest in logistics companies. You can invest in fulfillment companies. Here's just a few examples. Skip UPS, skip FedEx, go for the smaller ones. XPO Logistics, JB Hunt, Expeditors International, Coyote Logistics, Total Quality Logistics. I'll give them to you again. XPO, JB Hunt, Expeditors, Coyote Logistics, Total Quality Logistics. These are all long-term beneficiaries of this insane trend. Grandmas learned how to buy stuff from Amazon during COVID. Everyone learned. We trained an entire generation of people that never used the internet to buy stuff. Don't you want to be part of that?
Heck yeah, man.
All right. I'll skip this testimonial. You guys are in the industry, so you don't need to know. All right. So moving on. This is what I'm building. This is what my core belief is. I love doing value add, but the problem is everything sub 4 cap. So I'm moving over to new construction. And I know John Montero does the same thing, by the way. So Avondale Commons, 320 units, Class B. I'm not doing Class A. These are $1,600 in rents. I'm doing it in Phoenix. This is the fastest growing city in the US. Its population is growing at 2.6 times the US average. Job growth, which I track all the time, 5.8 times the US average. Just Google job growth in Phoenix over the last 12 months. It'll blow your mind. 200 people move there every day. And its rent growth is so incredible that no metro in the US even comes close. Take a look. Look at CBRE, look at Marcus and Millichap, look at Yardi Matrix. Nothing comes close. 4 out of 10 fastest growing cities in the US happen to be in Phoenix metros. And we're building in places with crazy rent growth. And these numbers are a little bit old. The rents are now up 16, 17%. We only build in suburbs, in places like Avondale. None of you have ever heard of Avondale. Don't bullshit me. Nobody has, right? It's a small city, but take a look at home price increases, 29.8% in a year. That's the kind of place that we're building on, and it's phenomenal. So this is the kind of product that we're building. And as you can see, we're taking advantage of all of this stuff that's happening. We've got, the units have office workspaces, private balconies, tall rooms, people want more space, botanical gardens with fake vertical gardens. You know, they're fake, you just hose them down, they're plastic, but they look so real. It's amazing. And we're also doing enclosed garages because Phoenix gets to 115 degrees. So we'll skip past all of the other stuff. I just wanted to show you what I'm doing. So here's trend number 3. And trend number 3 is very interesting. Those of you who've, attended any of my webinars know I talk about how Americans are moving to Boise, Phoenix, Austin, the Portland, and they're coming from New York, they're coming from California. So you've heard that before. It's well documented, right? We're now beginning to think that when we talked about this, we actually buried the leads. Yes, Phoenix and Boise and Austin all seeing insane growth. These people are clearly running away from California, but it's actually a much simpler way to make money from people that are moving from dense cities like Philadelphia, New York, Chicago, and Los Angeles, and that is suburbia. Our research, most recent research indicates that for every one person that moves from California to Texas or moves to Arizona, there's actually 3 people that move, and they move to much further suburbs in their own city. And this trend hasn't gotten as much attention as the interstate move, so we think it has more profit. COVID brainwashed 7 billion people. And if you believe that hybrid work is here to stay, you have to believe that the suburbs are going to do really, really well. On the top right on the screen, look at Chicago. It lost a bunch of people to its northern, richer suburbs. You see them up there, right? But guess where the prices rose the most? In Oak Park, in Berwyn, and in Oak Lawn. These are all rough and gritty suburbs. They're seeing crazy levels of gentrification, massively higher rents. So our message to you is, look in your own city, go out 30 or 40 miles, don't be afraid to look at the rougher suburbs. We think that's where the profit is. All right, so Neal, I get it. Far-flung, greedy suburbs, more attractive. Are you going to give me examples? Yes, time for you to write. If you live in and a lot of you are in Texas, I'll give you all the different stuff, then I'll give you some Texas. If you live in the San Francisco Bay Area, your best options might be Oakley, Brentwood, Modesto. Southern California, Glendora, La Cañada, Flint Ridge, Austinians absolutely should look at the city of Killeen. I keep saying this, and I don't think enough people are paying attention. Do you realize, have you looked at Austin? Austin is the hottest city in Texas, right? And I don't think even people in Dallas would dare to say, no, Dallas is hotter than Austin. None of the numbers support that. But have you looked at Austin? The only place to go from a city where home prices went up 44%, what are your choices? If you go east, you'll end up in Fredericksburg, way more expensive. If you go south, you have 2 options, San Marcos, and then 50 miles below that, New Braunfels, really expensive. So what options do poor people have? They have to go north. There's only one city north of Austin, Killeen. Why are syndicators not looking at Killeen? It makes all the freaking sense in the world. All right, I'm gonna boom, boom, boom. I'm gonna skip this testimonial too. You guys are in the industry. I'm also building this kind of product. So, I did a webinar 3 or 4 days. Some of you guys attended it. It's called Build to Rent. I see Build to Rent as huge. I see it as a risk for multifamily. I see this as massive competition. A lot of funds bought 80,000 homes in 2010, 11, 12, 13, 14, when they could buy these homes in bulk. Do you know that those homes beat the shit out of multifamily in terms of profit per unit? Why? Because they were simply single family homes and the home prices go up very fast. Today, More and more developers are looking to build to rent product and different kinds. I build stacked townhomes. This is a simpler, more straightforward product. I'm building it in the suburbs in a city called New Braunfels, about 20 miles north of San Antonio. Very nice city, upscale German town, high salaries. This is the kind of product that people actually want to live in. I've known this for a long time, and I think you do as well. People live in apartments because they have to. They don't want to live in apartments. They don't want to live in high density. They want something that's low density, but that's not as expensive as a single family home. And everyone has come to this conclusion that this kind of asset class is what people will really accept if they can't buy a single family home. Who can buy a single family home? Austin home prices went up $140,000 in a year. How many people do you know that get $140,000 raise in a year? Right? It's not working. It's not working. So there has to be something in the middle. And apartments obviously are benefiting. Every one of you know that the last 12 months have been the greatest rent increases in multifamily in history. All of you know that, right? But do you know how much rents went up in the build to rent category? They went completely freaking ballistic. 20, 30, 40% increases in the build to rent marketplace in rents in a single year. And do you know what cap rates are? Now I'm going to shock you. This is something you do not know. You know multifamily cap rates. There's people right now listening to me saying, yep, I've seen assets sell in the 3.5 to 4 cap range. Plenty of people, right? Ben, is that fair? 3.5 cap, 4 cap? Google
Absolutely,
a property called Urbana. Urbana. Urbana is in the middle of a field in East Austin, not the best part of Austin. Urbana is in contract for 2.75 cap. 2.75 freaking cap. That's built to rent. Nothing in multifamily matches built to rent. I think it's an incredible trend because COVID means people want more space, and sometimes that means larger apartments. So anybody who's buying apartments today should not be buying ones that have a lot of one studios and 1 bedrooms. You should be buying 2s. You should be buying 3s, but you should also be looking to buy townhomes because townhomes are renting in hours. In hours. So that's the kind of product that I've been very obsessed about. This is, of course, all pre-COVID work. It takes forever to zone these things. I look for this kind of crazy city, by the way. Look at this, 6.5 times population growth. And here's the one thing, this is a message that you've heard from me before if you've heard my stuff. Austin's great, Dallas is great, San Antonio is great. The money is always in the cities in the middle, right? Look at New Braunfels. Does Austin grow this fast? Does Dallas grow this fast? That's 6.5 times the US's population growth. Look at job growth down there. 4.7 times the US's job growth. Actually, it's 9.8 times the US's job growth. Those are insane numbers. You cannot get them in big cities. You have to look outside. You guys are too fixated, right? Look at this. This is going to completely drive you nuts. That's a 55% increase in income in New Braunfels. Nobody knows where New Braunfels is. Now you're beginning to realize this. But look at that last bar on the right. That is a 26% increase in income in 1 year. That's COVID for you. Those people are running from somewhere, some more dense place, to a beautiful place like New Braunfels with 230 days of sunshine. And this sort of stuff happens. Look at this, crazy shit. 26.5% home price increases. Look at the inventory. Homes basically sell as soon as they're listed. That's the kind of product. I like building townhomes. I find single family to be too expensive. So this is the kind of product that I'm building. I think Ben can build this. I think Ferris can build it. I think John's already thinking about building it right now, right? This is the kind of product that people want to live in. That's what the insides look like. And this is about, I'd say, $1.85 a square foot. It's not even Class A. I mean, you guys have apartments where you're charging more than $1.85 per square foot. I know that for sure. I know what Ben has. You're charging more than this for apartments. But when you build it, that's what you can afford to do this. $2,400 in rent, maybe $2,550. 1,400 square feet. Look at these kinds of trends. All right. Obviously, not all of you can do that. Maybe there's like 4 of you guys here. I've pointed them out that are probably looking at that going, hey, I need to look into this. But for the rest of you, this next one is super interesting, right? This is so exciting. Let's start with blockchain. At its most basic level, blockchain is literally just a chain of digital blocks. Blocks store information about transactions like date and time and dollar numbers. In simple terms, it's just a way to store transaction information in a decentralized database on the internet that the government cannot touch and cannot manipulate. Now, real estate transactions, for the most part, these are offline transactions, right? Escrow, title, 5 million things, go and get a physical rubber stamp. Very far from digital. But blockchain has, for the first time, opened up a way to change that. Smart contracts, which are up on the screen in the middle, smart contracts now allow anyone to digitize a physical asset, take over listings, payments, legal documentation, do it all in real time. So you're getting rid of all that escrow and title, lengthy paperwork, no need for brokers and lawyers and banks. Instead you have instant contracts, highest transparency, protected by the blockchain. So in my mind, blockchain and smart contracts are the key to making real estate a liquid asset class. Anybody who says real estate is liquid is lying. It takes you 5 minutes to buy Apple stock. It takes you 5,000 minutes to buy a home. That's not liquid. And while blockchain is good, smart contracts are good, they become 10 times more powerful when you combine them with the awesome power of tokenization. Because a smart token allows you to buy real estate the way you buy stock. As a seller, you break your property. Let's say, Ben's selling a multifamily, it's $50 million. He breaks it up into lots of pieces of $1,000 or $100. And then this property can be sold in pieces at the same time in a dozen online markets. 10,000 investors can own a piece of Ben's property. And they can Ben could use tokens to raise enough cash to bring equity into the property down to zero, basically kick out all of the equity. And then basically use tokenization sites to send earnings to token holders. Have you ever dreamed of this? Taking all of your investors out of your best deal? You could tokenize the property and remove your investors. Of course, your PPM needs to allow investors to be removed, which is why this is something that you guys have not done before. My new projects have a clause allowing me to remove investors. The first time I put that clause in, people were like, what the fuck is this? What are you putting in here? And I'm like, well, I still have to make you like 30% to remove you, right? So it's not like I'm cheating you, but what I'm saying is I have a clause in here saying, okay, if I give you a 30% return, I can keep the property by removing you. And you realize how difficult that is, because I don't just have to return your principal, I have to return all of your profits. To do that, I have to replace you. Maybe I can tokenize the entire property at 6 to 8%, sell 1 million pieces of it, bring that money in and replace investors. You should be adding clauses like that into your properties. Is this now beginning to make sense? It's so insane. And people are like, this can't be happening. There's laws against it. This is not crowdfunding, accredited versus non-accredited. Open your eyes, write down these words. Lofty, Lofty, lofty.ai. It's a website. Go there right now. You can buy stuff on the blockchain. You can use Bitcoin, you can use cash, $50. So in 20 minutes from now, you could own properties in 5 different cities. It's here. It's already here. It just hasn't gotten to multifamily yet. There's a dozen startups bringing it to multifamily. It's going to disrupt multifamily. First, it's going to be good for us. Then it's going to be bad for us. Why is it good? Every asset that becomes liquid rises in value. Throughout history, all liquid assets rise in value. Stock market, Bitcoin, anything that's easy to buy, it goes up in value. Good for us. We're sitting in this room. We're sitting on what, $5 billion in real estate? Good for us. The problem is, once it gets commoditized, the bigger companies tend to take over. The startups take over. The Amazon of this and the Amazon of that starts to push little guys like us out. So in the short run, tokenization is the greatest gift anyone in this room will ever receive. In the long run, it's going to take your job. So either figure out how to get on the other side of tokenization or plan for an early rich retirement. Those are your two options. Last one. I kept this one for the end because I think it's the most predictive of it all. And some of you guys know about this. You've just heard that inflation in the US is skyrocketing, right? As of yesterday, a new statistics came out that we have the highest inflation in the United States since 1990. We were at 6.3% by official numbers, which is 3x what it normally is, 4x what it normally is. By unofficial numbers, we hit 12%. Shadow stats, right? So some of you believe the Fed's inflation numbers, some of you believe shadow stats. I think the real number is actually somewhere in the middle. When we look deeper, we've found that the biggest cause of inflation in the US was actually coming from real estate construction. While there's many other causes, the biggest one is that any kind of material used to make buildings and homes has gone through the roof. Now, initially I blamed shutdown in lumber mills. And then I realized Canadian mills have been running at full capacity for the last 4 or 5 months. So I started looking at construction statistics and I found that more homes are being built in the US than at any other time in the last decade. Demand is astonishingly high. We also found that people all over the world, not just in America, everyone's decided they want to rehab their homes, add workspaces, gyms, rooms. And as you can imagine, it led to an insane increase in everything. Lumber, windows. I have to wait 5.5 months for garage doors. Before the pandemic, lumber prices were at $400. On the far right side of the screen, you can see what happened. That's $1,600. Lumber went up 4x. Now it went down and you might go, oh yeah, it was only up for a little while. It's on its way back up again, unfortunately, right? Crazy stuff is happening. And even at reduced prices, lumber is now 50% more. We think, and this is the biggest takeaway, inflation is real, inflation is worldwide. We think that this means that homes all over the world, real estate all over the world, will cost more to build for 5 years. That's our biggest conclusion. The rich want bigger homes and newer homes with health benefits and better views. Those upscale homes, they're the ones that are selling the fastest. Did you know that? Amongst single family homes, it's upscale homes that are going up the fastest because the rich want more space. The middle class now wants backyards. They want workspaces. They want exercise rooms. So their demand is up. The lower middle class wants apartments with more rooms, just rooms. Everyone wants more, just like Oprah on the screen. And the Fed is still providing fuel with low interest rates. Yes, interest rates will go up. It'll go up two times next year, 1/4 point and 1/4 point. For anyone who thinks that that's going to end the party, what have you been doing the last 6 years? The Fed raised interest rates 5 times in the last cycle, not twice, 5 times. It did take them 3 years to raise those. And did that cause cap rates anywhere in the United States to even plateau? No. No market in the United States plateaued. All of them continued downward for cap rates, while not 1, not 2, but 5 interest rate hikes were made by the Fed. Just remember what happened. It will happen again. Cap rates are not going to stop declining just because 1 or 2 interest rate hikes happen. Now, I do believe that if 5 of them happen, which should be maybe late 2023 or early 2024, by that time we'll plateau. But if we plateau in the 3s, are you going to complain about it, sir? No, you're not. Everyone and their mother wants to sit on an asset that plateaus in the low 3 caps. We think at this point, it makes no sense not to buy assets. I love building assets. It's more fun for me. It's more creative. I get to pick stuff. It's also highly complex. Most people can't do it. So I'm in a market that's a little bit isolated. But I tell you, at this point, it makes all the sense in the world to buy assets. There's definitely more rent increases coming. Everyone's been saying rents have to slow down. Did you read the Yardi Matrix report that came out earlier today? October accelerated from September, which was already a record. September accelerated from August, which was already an all-time record. We continue to set all-time records. the last 3 months have had the highest rent increases and the highest occupancy of all time. And if you think that your city is crazy, please take a look at Boise, Idaho. 39% increases in rent in a year. 4 of these 10 are in Phoenix. This is happening everywhere. It's happening in your metro. It's happening in every other metro. It's all over the place. It makes absolutely no sense at this point of time to get out of real estate. We don't think the real estate market is in a bubble because 7 billion people think differently about the place that they live in. And that's obvious now. If this chart doesn't convince you that 7 billion people think differently, absolutely nothing will. 5 years ago, you wouldn't have one city in the United States that would even compete with the last city on this chart. Now there's 10 of them and rising. It's just completely insane. If you don't think that multifamily is cheap, buy lumber ETFs. There's lots of lumber ETFs because people will build a lot of homes. Buy stocks, buy Lennar, buy KB Homes, buy Polt. Of course, all of these guys are getting into build to rent, but that's another story. But in the meantime, I think that home builder stocks make a lot of sense because I think we're about to make a truckload of homes in the United States. I don't think that changes in the next 12 months. Maybe it changes the next 2 years. I'm not suggesting you keep these stocks for 5 years, but I think that there's a lot of money to be made there because this is an astonishing trend. I tell you, I'm the kind of person that lives by data. I printed this and stuck it on my wall so I can look at it every day that there's a city in the United States where rents went up 39% in a year. And oh, by the way, if you think they're slowing down, they went up 3% last month. That's the market that you're in. We're in the market of a lifetime. So I hope you enjoy. If you're interested in new construction products or build to rent products, let us know, contact us. I don't think that you're that sort of crowd, but I just feel like we're in an amazing space. I feel fantastically blessed. That's my presentation.
All right, man. Well, thank you, Neal. I mean, I typically kind of zone out sometimes when people are talking on this. I was completely engaged. I agree with all of your points as well, right? I think I'll be selfish and ask a few of the questions just to kind of kickstart some things. I asked some other people to do some Q&A. You still got a couple minutes for us, right?
Sure.
To do a couple questions. So can you slow down for some of us that are a little bit slower on the tokenization and the crypto? That has been the buzz, right? And there's been some people that have made a fortune over the last 12 months, right? And I mean, we've started dabbling into it, and I know it probably better than some folks in our industry, but
sure.
Can you kind of talk about the fractional ownership and the liquidity and a little bit more about the advantages of kind of looking into that and how it's really, like you said, I think it's going to drive cap rates down. And, I mean, so that's a huge thing. And, just wanted to kind of see if you could kind of maybe take a little bit of time and talk about that a little bit more.
Sure. In this presentation, I talked about certain cities. I talked about Idaho Falls. I said, that's a great market. St. George is a great market. We talked about a few others that you guys have not heard of. I said Killeen's a great market. The problem with real estate is if Anton had, $10,000 burning a hole in his pocket, there really is no way for Anton by tomorrow morning to buy, have some kind of real estate exposure in Idaho Falls and St. George and Killeen. No one can do that. And for the longest time, that's been the greatest frustration with real estate. You go to a party, somebody tells you a great story. You can't fish out your phone, tap Robinhood, and do what everyone's doing for stocks, right? And so real estate doesn't ever get to its true value because it's illiquid. Tokenization is simply the process, the auto magic process of taking a property, and could be a multifamily, it could be a hotel, it could be a parking lot that is rented. And so you have Ben, he decides to buy a multifamily property, and normally he syndicates it to investors. And that's a pretty good strategy. It's called crowdfunding. We've all been doing it for years. The problem is, you have to be accredited, and you're trying to, raise money, and you have to know those investors, and you have to talk with them individually. It's a retail process, right? Can you imagine the CEO of Apple, Tim Cook, knowing the 17 million people that have invested into Apple, that's not how it works. He just simply says, I'm going to take a piece of my stock and I'm going to put it into this thing called the stock exchange, and people will then pick up that stock, right? Now, the systems and processes and the background infrastructure and the software to do that with real estate is now here. So Ben will be able to talk to a bunch of different people, a bunch of different companies that are building backend infrastructure. There's IPOs coming in the second half of this year. There's a company coming out of stealth mode in the first half of next year that are going to say, Ben, you want to list your property? I'll do it for you. You don't worry, Ben. You don't think about whether it's Bitcoin or blockchain or, none of that matters to you. All you care about is you create tokens, people buy those tokens. And when you issue rent checks, the person gets the rent check benefits based on how many tokens they purchase. You never have to know them. They never have to know you. You don't have to validate that they're accredited. You have a truly liquid asset. And you're putting it not on just one website, because think about the stock exchange. What is a stock exchange? There is no such thing as a stock exchange. There's the Chicago Stock Exchange, the New York Stock Exchange. There's actually a bunch of exchanges. US companies are even traded in Asia. So the beauty of real estate is that Ben doesn't want his 200 unit multifamily to be on one exchange. He wants it to be on all of them. So if a dozen companies have exchanges, Ben wants to list his property on all of them. And most importantly, if somebody buys a token on one of them, he should be able to sell that token on any other of them. Imagine the amount of technology and backend infrastructure that's needed to make sure that some weird thing doesn't happen. If Ben is selling 4 million tokens, at any point of time in the universe, there should only be 4 million, right? Now, but with stocks, the SEC has written and developed this software over decades. But the blockchain, which was never written to do this, it achieves it by default. The blockchain will prevent there from being one extra token out of 4 million. Ben doesn't care. And that's the beauty of the blockchain. It will absolutely prevent there from being an extra token. There will only ever be 4 million pieces, and people will be able to trade their stock in and out. Only it's real estate. What an amazing thing to happen. And it's going to happen starting now. And I'm saying the first company to do it that I know of is lofty.ai. Go to their website, go out, homework for you. Please buy $10 each worth of stock in 5 different homes, in 5 different properties. And you're like, just $10 each? Yes. You learn how the process is working, right? You learn how you buy stock. You learn how they're doing it. And then when they send you distributions, you learn how this works. Because I can tell you one thing, Lofty.ai doesn't know how these tokens are moving. Lofty is the front end. There's got to be somebody running the back end. And those back end providers are about to make billions and billions of dollars. Because the people who made the back end for the stock exchange in the 80s and the 70s and the 90s, those people ended up being mega billionaires. And the same thing's now happening to real estate. It's real estate turned into stock. It's mind-blowing.
Love it. Love it. Ferris, man, you got any questions? Or we'll go to see if we have anything coming up on the board here with the chat. So anybody that has questions, folks, ask. Neal just told us earlier, this is the only speaking engagement he's got the whole quarter. So use
That's
this
right.
as an opportunity. But if not, I'm going to continue to selfishly, pick your brain a little bit. All right, we got one that came in. All right, can you please repeat the name of the platform that you just said, right?
Lofty, LOFTY.ai, not .com, .ai. A lot of these new companies, they use .ai or .app. This one uses .ai. They're basically a technology company. I can tell you these technologists are going to overrun us in 10 years. Remember my famous quote, right? The only one I ever wrote myself. It's the Bible was wrong by one letter. It's not the meek that shall inherit the earth. The geek.
I remember that one. I like it though. I like it. All right. So we talked about tokenization. Let's talk. You had talked at least in past presentations about some of the markets, and you threw some of them out there, right? but once again, I'm selfishly just going to ask you straight up, beyond it just being tertiary suburbs, get it, right? You mentioned Phoenix, get that one. Obviously, everybody's probably should be looking at Boise if that's going to continue. What are some stuff in the Sun Belt beyond the Arizona market that you're kind of still taking a peek at?
Okay, so I'll start with Texas since a lot of you guys are there. So I mentioned Killeen already. That is a very powerful market. El Paso is considered like an armpit, but my metrics show it to be a very strong market in the next 12 months. There's also a market that is on the east side of, it's very east in Texas, one of the most east markets. I can't remember. It's in that oil belt, so I haven't looked at it. It'll come back to me in a minute.
Longview.
Longview, that's right.
Longview?
So Longview is a market that I've long looked at and been afraid of because it's heavily dependent on the oil side, but its current metrics are extremely strong. So look for rents to jump massively in Longview. Obviously, the rest of the markets in Texas, you guys know, and you guys know that they're fantastic markets. I'm continuing to invest. I tend to track corridors, so I do what is known as compression cities, cities that are in between two things pushing at them. The best compression city in America happens to be in Texas. Its name is New Braunfels.
Because I'm going to give you a tip, Neal.
In between the two, Austin and San Antonio. Yep.
So everyone in Texas knows the city, but it's New Braunfels.
Yeah, New Braunfels. Yeah, I know.
It.
My staff is always telling me to fix that, and I'm like, no, I think I'm fine. I'm sticking with what I've got.
No, it's got Schlitterbahn. I mean, I think everybody that's from Texas.
It's got Schlitterbahn and it's got the rivers. That's what everybody knows it for. Those two things.
And it's got the best water park in the world. It's definitely a beautiful place. Veramundi they're building, I think, about 2,400 homes there. It's a $2 billion project. 10% of the entire city of New Braunfels. They've already built 1,000.
Yeah,
they're filled. So there's some amazing things happening there. So those are some in Texas. I really like the corridor. So I'm very obsessed with this concept of corridors. A long time ago when I met you guys and I came over to Houston, I talked about this corridor that started from north of Florida, then ran through Orlando and went to Tampa. Tampa has the joint highest rent increases with Phoenix right now. And then it turns south and it goes through Bradenton, Sarasota, and it ends in Fort Myers. That was my favorite corridors 3 years ago. It's not anymore. One of my favorite corridors now is basically Charlotte, Raleigh, going through Greenville, South Carolina, ending up in Atlanta. That's the longest corridor I've ever researched, but it's very powerful. It has all kinds of knock-on effects. It has all kinds of compounding effects where the cities in the corridor are basically just building on each other. The most profitable probably is Greenville, simply because it's the smallest. Atlanta, everybody knows about, but if you look at Charlotte or the metro Charlotte, so don't look at Charlotte, look at like 40 miles from Charlotte, you'll see a bunch of amazing cities out there. So that North Carolina and Idaho are the only states in the United States where every city right now is running at max. They're all running at 10 out of 10. This rarely happens. Texas is running 10 out of 10 for a while, but of course you can't constantly run 10 out of 10. It doesn't work, right? So Dallas has definitely seen a bit of a slowdown. Austin's still going like crazy. San Antonio is behind Austin, so it'll go like crazy for a while. And Houston seems to now be speeding up, even though it's not been at 10 for a long time, but it's definitely beginning to show acceleration. I saw some home price data from Houston. It was very, very juicy and it was very recent. So I think like it's going to climb for a while. But I think markets like Galveston, which people tend to ignore in my mind, should be looking at Galveston. If you believe in Houston, why don't you believe in Galveston? Yes, I know you're a little bit afraid of the hurricanes and things like that, but hey, just buy more insurance, goddammit. And don't buy something that's at a very low level for flooding. So, build your own flooding maps, stay 4 or 5 feet above that flood level and you're fine. Cities only flood for a day or two. It's no big deal, right?
All right, so we got a couple questions, man. So Richard asks, how do we learn of the other 5 trends that you couldn't get to? I'm sure Neal probably has, like he had on this last slide, there's probably a sign up where you can kind of reach out to Neal's staff.
Simple, really.
Yeah.
It's multifamilyu.com. It's on the homepage. So all 10 trends are on the homepage of multifamilyu.com. Some of them are very exciting. Some of them are a little bit further out. You know, I picked these because you guys are in the market. You need to make money now. Everything I talked about today is money that you can make now. Some of these trends are bigger, but they're not quite here yet. So like 15-minute cities is a very powerful concept. Healthy homes is extremely powerful, and we're beginning to see that, but it's, in my mind, it's more of a stock investment. There's a company called Delos. If you can land your hands on, it's a Texas-based company, DELOS. I think this company is going to be worth $100 billion. They're amazing. They have an astonishing product.
I was going to ask, you know, I mean, and we've had this conversation, I think, over dinner several years ago about self-driving cars. Ferris might have an opinion on this too. So what do you see? I mean, ultimately, I don't know if that's been accelerated because of COVID, but I mean, it was ultimately, everything seems to kind of be moving a little bit more fast towards that because of Tesla and Elon's popularity and everything like that, right? Do you see that trend continuing? I mean, or when you know, because ultimately I see self-driving as very extremely disruptive to real estate in general, right? Because no longer, you know, say you have to go into the office, right? No longer do you necessarily have to be that close, you know, because you're not going to be fighting the traffic anyway. Somebody else is going to be driving for you. You can be checking emails and reading a book and relaxing the whole drive in, or you're no longer going to have to drive your kids to school, you know, on your own. It's going to be a whole revolutionary way of society. What's your thoughts on self-driving vehicles?
It's the single greatest disruption to real estate in the last 100 years. Nothing comes close to it. COVID is not even a shadow compared to what self-driving is going to do. But I don't think it happens in the next 5 years, because for self-driving to truly work, a series of benchmarks have to be achieved. Early self-driving is simply rich people who don't want to drive. They want a chauffeur. That's what's coming in the next 3 to 4 years. You buy a new Tesla, you use their system. GM has a really good one called Super Cruise that is getting to the marketplace. You know, Toyota's building a very nice one, and Hyundai always impresses me with the sort of stuff that they're building. So everyone's building stuff for rich people who don't want to drive. And I think that's our next 4 to 5 years. But beyond that point, the taxi stuff is going to get cheaper. Right now, the taxi stuff doesn't mean anything because they're really expensive. I mean, you know, all of these taxi companies, they're losing money, right? Waymo's lost billions and billions of dollars. It takes a long time to get to scale where they start to compete and they start to actually make a change to real estate. So I expect no changes to real estate in the next 5 years. I expect disastrous. Nothing good will come out of it for real estate. It's bad for real estate in every way that you slice it, because it basically allows you to live anywhere in the goddamn country. It allows you to make cities 100 miles in radius, because self-driving cars will also drive at over 100 miles an hour by using something known as slipstream. They'll basically be 2 inches from each other. So only the front car has air resistance. They can go to 100 miles an hour and still hit 200 miles to the gallon. And when you do that, you're opening up the rest of the US, which is really bad news because real estate is based on scarcity. And only 4% of the land in the US is used for homes. The remaining 96% is still out there. We just have no access to it. Self-driving car takes that from 4% to like 10 or 11% that we have access to. So it's disastrous news for real estate. I don't think it has impact in the next 5 years. That's why it's not in our disruptive trends yet. Same thing for 3D printing. We don't think 3D printing has an impact in the next 5 years. Beyond 5 years, it's freaking crazy. Look at what is being built in Austin right now, 100-unit community. We're not talking about Africa. We're talking about Austin. So 3D printing is absolutely disruptive. They still have to figure a bunch of shit out. They still have to get approvals in various cities. So those two are amazing trends for my 2025 disruptive trends presentation.
All right, we're going to stay tuned then on that one, man. All right, so Amir says, what's your advice to somebody new entering the space? You know, they're LP investor currently. I'm sure it's just, you probably get this a lot. You know, I mean, you know, what should somebody do to kind of hop in and, you know, kind of being more on the active side, I guess?
Well, being more on the active side, you're doing the right thing. You're here, right? So on the LP side, what I would say is that this is a time to be a little bit careful. All of us are paying a lot for properties. I'll give you an extreme example. I have a property for $10.9 million, built a bunch of units inside of it. sold it for 23.3 million, and the next day bought it back myself. I had to sell it publicly because I didn't want my investors to think I was basically selling it at undervalue. So I hired a broker, $150,000, 20 companies showed up. Somebody bid 23.3, I bought it. Now, I bought it because I know I can build 48 more units, but I would have bought it anyway because I'm not seeing a lot of properties out there that I want to buy. So it's a tough time. You have to be careful in your choice of syndicators. You have to make sure that they have a really good plan for what to do going forward. Having said that, the market and the trends are very, very highly supportive of further cap compression. Very, very highly supportive.
Absolutely. Absolutely. All right. So we've got another question, getting very specific here. What do you think about coastal markets like Wilmington, North Carolina, Charleston, South Carolina, and Hilton Head?
Charleston, I think, is the best of that bunch. I think Charleston has proven itself. There is a corridor that we are tracking. It hasn't fully developed yet, but it runs from Charleston to Myrtle Beach. So I think, once again, you know, I've already said this 50 times. It's not about Charleston or Myrtle Beach. It's always the community in the middle. It's the age of the tertiary market. Drive roughly, I'd say, 50 miles east of Charleston, going towards Myrtle Beach, and look around you and see if you like it there.
Absolutely. All right. So we're still waiting on a couple things, a couple questions come in, but John, I see you waiting breathlessly, my friend. Do you have some questions, or Ferris or Anton, you know, that we can kind of, you know, stoke the conversation a little bit?
Sure.
Yeah,
I'm doing that. So playing a little bit of devil's advocate to this build to rent. Ivy Selman, she is probably one of the most famous housing analysts, and she called the crash in 2007, 8, and 9.
Yes.
Now she has a little bit of a different view of where housing.
I'm a huge fan, so I know exactly what Ivy Zellman's saying. Did you notice that she sold her company to Walker Dunlop? So she is now a division of Walker Dunlop. So I'll answer your question. I know exactly what you're asking, Anton.
Okay.
Ivy Zellman is right. Ivy Zellman says no one is paying attention to the fact that US population growth has just screeched to a halt. We were growing at 1% a year, then we were growing at 0.5%, and some of it was because of, you know, immigration. Now it doesn't matter if the Democrats or the Republicans are in power. We just don't have immigration in this country anymore, right? It's not happening. The Mexicans are afraid. They're not, you know, coming over. Yeah, there's all this hype on TV and Fox News, but look at the actual immigration numbers. Everybody knows they're down, right? Bottom line is the country is not growing very fast. There's other demographic shifts that are affecting us. So Ivy says, you guys keep thinking you need 5.5 million homes. That's not true. By 2026, 2027 at the latest, you're not going to have a housing shortage anymore. The answer is, I think she is right. The only thing that I feel that she's weak on, Anton, is that time frame that she talks about. She's quite weak on. Demographic trends don't hit all at once. Folks like Ivy, they're economists. They try to turn everything into numbers. And I used to do that as well, and it didn't work. You know what I found? Economists are often wrong, not because their math is wrong, because their timing is wrong. I think she's off by a couple of years. I think that basically the housing shortage in the US will be gone by 2027, not 2025, which means I want to get out of this market by 2024. Maybe 2025 at the most. And that she's not even saying 3D printing, because 3D printing can take the housing shortage apart as well by the time we get to scale. So for the record, I think she's 100% right. I think she's just a little bit too bullish on how quickly the demand dissipates, because money coming into the United States is coming from 200 other countries that want to be us. And she's not factoring in on that greed. She's simply looking at demographics. The problem is the demographics people don't understand greed. They don't understand money being raised by funds. Let me give you an example of build to rent. Okay. $41 billion was raised in the build to rent market in the last 12 months. That's when you leverage it, that's $120 billion of asset. That's 2,400 $50 million properties. There's only 100 of them being built right now. There's 2,400 for which money has already been raised, and they're still raising $1 billion a month. So forget that. But what they've already raised, they have this hunger. They will drive the price of assets down regardless of the number of people that are available to rent it. So I do think that what's going to happen, Anton, is this. The lowest, most useless, crappiest assets that are 50s and 60s and 70s, by the 2025, they'll be down to 70% occupancy. But I don't think that high quality assets are going to be at 70%. But I think by 27, 28, we better look for a new gig, because between 3D printing and the demographic cliff that Ivy is correctly talking about, the real estate shortage will be wiped out. She's got
What
it.
about short term on the build to rent? As you mentioned, 40 billion. I think some analysts talk about 75 billion being committed. Who knows exactly what the true number is?
I'll just take the smaller number. It's still a big number, right? So
Right,
if
yeah.
they commit $40 billion, let's do the math on that and see if it hurts the US. It doesn't, and I'll explain why. All built to rent is new construction, correct? You know what's happening to construction prices. So let's just do the math. Let's say that there's 40 billion committed. Let's leverage it. Now it's 120 billion, right? So you basically, well, let's make it 160 billion. Let's say they're doing 25% down, 75%. Normally they do more in construction, but I'll use those numbers. So it's 160 billion bucks. Okay, a typical build to rent community is 250 units, and 200 units, and sells for 60 million. So Arbana is a perfect example. It's 150 units and still sold for 60 million. So I'm being generous here, right? So it's 200 units, it sells for 60 million bucks. So if for 60 million bucks you sell one community, right? That's 200 units. Basically, each unit is going to cost you what? $300,000, right? So if you simply take the $160 billion and divide it by 300,000, the unit count you end up with is not going to disrupt a market of this size. They cannot build enough. And here's the most important part of it. Let's assume they can build enough. Okay, let's assume that for all of those 160 billion, someone is right now building enough build to rent. Okay, that number still is nothing compared to the shortage. It's too small because this is high-end, expensive homes, $300,000 a unit. You can't solve the problems that we have at 300,000 a unit. Okay, it's too expensive. But here's the real story, Anton. I'm a build to rent developer. I'm tracking how many properties are being built. They're only building at this time enough properties for roughly 10 or $12 billion to get absorbed out of that 160. Who's building the rest? Somebody will build them in the future, but nobody is building them now. So the construction activity does not match the amount of money raised. I don't think it's a threat to multifamily yet. I think in 5 to 10 years, build to rent is a threat because it's a better product.
Yep, absolutely. Well, I know we're running a little bit over. I think we might have chance for one more question here.
Yeah, I gotta go then, but let's take one more.
All right, I'll take one more. All right, and this is a shout out for you. So, what are some educational programs you would recommend for somebody getting into multifamily? Right? Can you go ahead and let everybody know what you got?
I used to have a boot camp. I don't like the long-term programs where you do coaching. That's not my thing. I used to have a boot camp. I shut it down. Why did I shut it down? It was profitable, but it didn't scale like my projects. I've got an $800 million portfolio to run and aspirations of going public. It's not active at this point in time. We do it once in a year. You're welcome to come to the San Francisco Bay Area. It's a 4-day boot camp. It's very tech heavy. It's very fast. But there's lots of excellent programs out there, right? So I know Ben and Ferris are doing something, but there's so many others. I think my advice would be simply get education as quickly as you can right now. You're in a window. It doesn't last. If you're new, you need to get your feet wet right now.
Best time to buy real estate is right now, right, my friend?
Absolutely.
Well, hey, Neal, thank you, sir. Definitely educational as always, and you had some controversy in there as well, right? So we
I
really,
like
really
that.
appreciate it. Don't want
That's
to
what
take
Neal
up any more
does.
of your time. Yeah, I know you got to run, but you know, I think everybody would say thank you to you, sir, and we look forward to meeting you here face to face here soon.
Thanks, everyone. Anton,
Thank you
I
very
need a
much.
lender for 4 plexes in Texas for that project. You want to lend to my millionaire investors? Please contact me.
Sounds good.
All right.
Okay, look at this.
Thank you.
All right, it's already working. Thanks, Neal. We appreciate
All
it,
right.
buddy.
Bye.
All right. So for those that can stay around, I think we're going to do probably one round of breakouts, and then we'll probably wrap it up because we are running a little bit long. So, you know, this is what it's all about, folks. Is a little bit of networking. Obviously, you got a lot of education. It's like getting, you know, shot with a fire hydrant when Mr. Neal Bawa comes in. But you know, stay for the relationships and the networking if you would. And Ferris, you want to go ahead and do the breakouts for everybody?
Yep.
All right. Look forward to seeing you in there.
All right, welcome back, everybody. Hopefully people got some value from that. You met someone cool and learned something new. And with that said, we will leave this room open for whoever wants to network and just kind of has their networking game on, and we'll leave this open for those people to go ahead and just kind of feel free to chat. But for the rest of you, thank you guys very much for attending, and we'll see you guys next time. Thank you.
Hi everyone. Does anyone know, will this group have another meeting like this or in person anytime soon?
I think it was December 2nd, or was
I think they mentioned something like next weekend, but I didn't catch that. Maybe I'll check out their Facebook group and see, maybe they have something there.
If not the Facebook group, the meetup page on Meetup,
Yeah.
usually they put a lot of their meetings on there as well.
Yeah, that's how I found out about this one, so hopefully. All right, well, good night, everyone. It was nice meeting the people from my breakout room. I hope everyone have a good night.
You too.